Okay, welcome everyone to our Ask the Experts webinar today. We appreciate each of you joining. We're grateful to be able to spend the next hour with you. My name is Bill Maloney. I'm an Executive Managing Director with Riveron. We're looking forward to engaging with you during the next hour on really an important topic, lease accounting, and less so this time on the adoption of the new guidance, but much more now on the day two impacts. And this day two work, which really is everything post-adoption, is critical. Optimizing processes, dealing with transactions like business combinations that impact your lease portfolio, and working through governance and audit challenges. There was a huge rush, early on to comply with the new lease accounting standard, understandably, and seemingly, though, few companies really anticipated the ripple effect of the cleanup activities that would emerge following the adoption. And now we're seeing a number of companies with a growing list of challenges, the need to step back a bit and sort out how to really have a sustainable process that is set up for long-term success. So to help with that, I'm joined today by four of my colleagues who are experts in the leasing space. Adi Mehta is a Managing Director in our Houston office. David DePippo is a Director in our DC office. Catherine Mazzolini is a Senior Manager in our Minneapolis office. And Stephen Saywitz is a Senior Manager in our Dallas office. So really looking forward to hearing from each of these experts, their different experiences as they highlight some of the lessons that they've learned from public company adopters. They'll address some of the common pitfalls that we're seeing, and they'll also share some actionable steps that you can take to reduce the burden on your lease accounting administration. Before we jump into the content today, a few key reminders. On our website, riveron.com, you can access all of our previous Ask the Experts webinars. There's a number of key insights there on accounting, reporting, and operational topics. Our next webinar is going to be on August 13th, so mark your calendars for that. During the webinar today, we'll include 4 polling questions, one of which is coming up here shortly. They must be answered to be eligible for CPE. Please make sure that you enable your pop-ups. If they're disabled, you won't be able to see the questions. And on that note, we welcome your questions. There is a Q&A option in Zoom that you can use. Please feel free to do that. We've actually already received a question. We'll try to get to all the questions, but if we don't, we will respond to you separately. The webinar evaluation form and the CPE certificate will be emailed to you within a couple of weeks following the webinar, along with access to the presentation today and our contact information. One thing to note, while the on-demand video will be available on our website, the on-demand is not eligible for CPE. Okay, with that, let's get started and get rolling here with polling question number 1, which says, how would you describe the current state of your lease accounting process? A, it's robust. Specified individuals or teams are assigned to manage the lease portfolio and process flow is established. B, it's a work in progress, working to identify individuals who will be responsible and refine process flow. C, have not started identifying responsible team members or defining process flow. Or D, not applicable. Again, remember to enable your pop-ups. Go ahead and take just a minute to respond. And Stephen, while we're waiting for the answers to come in, and as you and Catherine get rolling on talking to us about optimizing the lease process, can you just briefly highlight, give some context or overview of what your experience has been working with clients on their adoption of the new guidance?
Yeah, of course. Thanks, Bill. I'm glad to talk to that. First off, from our experience, there really was a wide range in terms of starting points for an organization's lease accounting process. Prior to 842, lease accounting often was managed in a decentralized manner. However, the new guidance has really brought the need for more visibility and standardized activities and policies to be applied. We'll get into this a little bit more as we go through the content, but wanted to go through some of the polling results as they come in. And, with that, hopefully everyone can see, it looks like majority, 34% of the participants have responded that it is a work in progress, followed by not applicable. So depending on your situation, you may or may not have an answer to this, but then also closely followed by robust, which is very encouraging. And then some of the participants, you haven't started. So again, going back to my point that there really is a wide range in terms of where everyone is in this process, but hopefully as we go through this, you'll kind of see what the end goal could and should look like in terms of optimizing this business area. So kind of getting back into that, lease accounting implementation and adoption was really a big lift when you went through it for public companies back in 2019. It required a lot of input and expertise from a variety of resources within the organization. And, one key thing I often noted quite immediately is that it takes a lot of cross-departmental coordination where you're pulling data from a variety of areas within the company. These areas would include legal, operations, individual markets, accounting, and even real estate groups if you did have a dedicated real estate department. All these sources contributed to collecting specific inputs and making policy decisions impacting the overall accounting output. As companies are really moving past adoption and into management of your lease portfolio, there are a variety of activities, both that could be reactive as well as proactive, that companies can expect to go through. So one of these first adoption activities is the handoff from the implementation team to your go-forward lease management team. This especially is going to require thoughtful planning when a third-party implementation partner was used for adoption and system implementation if a lease accounting tool was used. This is an area Riveron often played a role with working with our clients. So I can provide some real-world examples as we get into the details here. As I mentioned, I can attest these are temporary resources held much of the institutional and tactical knowledge needed to maintain a lease accounting on a go-forward basis. In a lot of our projects, as we close them out, we were sure to make sure that proper documentation of policy decisions, system functionalities, and really the overall business process were validated by management and memorialized for future reference. Not only does this make sure that everybody involved in the implementation and handoff are on the same page, but it also helps manage and onboard new resources effectively as your organization scales either upwards or downwards, of course, depending on your situation. What you're doing here is basically creating desktop manuals and system guides to support the most common decisions and procedures relevant to your portfolio and going to be required in your daily and monthly lease process. It's kind of like a general accounting close checklist. You can make lease accounting activity logs with owners, due dates, activities, things of that sort to follow throughout the month, ultimately instilling accountability to the process. Really what you want to do is give this new lease accounting area the appreciation it deserves, because it does take a lot to get to your ultimate accounting needs. Along with memorializing these key areas of adoptions, you want to set up the right org structure to manage a lease portfolio long-term and promote sustainability on the operations. Again, like other corporate accounting functions, lease accounting should have the right people, process, and technologies in place to support the operation and accounting needs. This can take form as either dedicated lease accountants or specified roles and responsibilities within the job function. I remember at one point as we were going through some implementations, a lot of companies were posting more formal lease accountant or lease director positions within their accounting group to fill resource gaps required from the new guidance. Sometimes this was identified early on in the implementation, or, again, going back to the handoff, identified as a potential handoff recipient as adoption already occurred. One operating model we often promoted, especially for large multinational and multi-business unit organizations, is a center of excellence model with dedicated subject matter experts really managing the day-to-day activities. These SMEs, as you call it, ideally would have appropriate accounting and system competencies needed to manage the whole end-to-end process. They could support the business with owning or helping others with data abstraction, system usage, accounting explanations, and ultimately reporting, both from a management reporting on a monthly basis as well as your disclosure reporting on a quarterly basis. A variety of factors play a role in determining what this structure will look like, some of which include lease complexity. Sometimes real estate leases can be a little bit more complex than non-real estate. You can have high volume of IT leases, vehicle fleets, things of that sort. So taking that into consideration, also the lease volume, geographies, business units, and also your ERP environment. Do you have one ERP, multiple ERPs? All of this plays a role in deciding what the proper processes should be in place to complete your accounting month to month. So just an example of how this works in practice, let's say an organization needs to collect lease agreements across various geos and business units. They're a multinational company or they're a national organization that has different business units within the US. A centralized group can ensure proper data flow and utilize specific tools to support the abstraction and inputs from the markets that are entered into a lease system. This helps create, again, the competencies by a few people to know exactly how to do it while still getting input from others within the field or markets that are a little bit closer to the agreements. This COE group can also help with month-end reconciliations, roll forward analysis, and again, the disclosure reporting that this is essentially a compliance need for. Again, creating consistency and building scalable competencies are a result of this operating model to meet the ongoing lease accounting needs. One specific focus area I want to call out where we talk about the Center of Excellence model or even a lease accounting group or job function would be involved with is contract management component of the lease process lifecycle. Like a procure-to-pay business process, the various steps of the transaction lifecycle play a role in the end goal and objective of the transaction. Pre-42, these lease agreements may have been prepared, reviewed, executed, and even began with accounting only finding out, months later. With the new guidance, the need for finance and accounting to be part of this process early on is even more important and really could prevent some, key things such as prior period adjustments and catch-up entries months after the agreement was executed or began. A controlled contract management lifecycle for lease agreements promotes completeness and data abstraction and is going to raise attention to terms and variables which can have a direct impact on the accounting. Again, to give some real-world example, one of the classification tests performed for new leases compares the present value of cash payments to the fair market value of the asset. The resulting percent can sway the classification and consequently how amounts are going to be represented in the P&L. Controls around this process can create opportunities to evaluate lease terms and make sure that they comply with company policies and spend limits, ultimately reducing unnecessary or unwanted costs. Something I think every organization is, paying attention to now more than ever. Some lease accounting systems actually include a lease versus buy module, as well as sourcing platforms that can integrate cost considerations into the workflow. Ultimately, setting up an efficient lease to contract management workflow helps increase this transparency and visibility into the agreements that, again, previously could have just been overlooked and not really paid attention to from a spend standpoint. Now, Catherine, I know you've worked on a bunch of implementations, some of which we worked together. Have you heard of any areas of contract management that have been impactful post-adoption? And, this can either be around the existing portfolio, managing the amendments, or entering into new initial agreements.
Yeah, Stephen, I have. I think that abstraction for leases in all of those categories is a key area to consider as a critical day two activity. There can be both a cleanup effort for data gathered during the implementation, as well as collecting inputs from new and amended agreements. Specifically for the cleanup data, we've seen companies discover that incorrect lease data was used in adoption. This commonly was caused by rushed implementations, to meet the adoption deadline, insufficient knowledge of the guidance, or just a lack of planning on what data points are required for both compliance and operational purposes. Regardless of the reasoning, the necessary data checks may have been overlooked or deemed immaterial at the time of adoption. And these variances can potentially be identified through monthly AP reconciliations when checking if cash payments match the accounting results per the lease record inputs. If the reconciliation or variance analysis shows a potential inconsistency, a one-time cleanup or update of the lease record may be warranted. Something that I've seen companies incorrectly abstract is the remaining term of a lease. If the lease term is incorrect when a company adopts, everything from the monthly journal entries to the management and renewal process of the lease will be impacted. If it is discovered post-adoption that the lease term was incorrectly abstracted, a catch-up journal entry will need to be booked, and calculating this even while using a lease management system can be very time-intensive and complicated. It's important to recognize not only if the abstracted data is accurate, but also to ensure that the leases were included, that all leases were included in the adoptive population. Leases may be embedded within contracts, and such it's important for the accounting team to educate all operational groups that are entering into any type of business contract on the key attributes to look for and ways to identify an embedded lease within those contracts. There are other one-time events that can also occur post-adoption, such as becoming aware of early terminations or extension of lease terms. One-time events like these are another reason why it is important to ensure that there is a team or individual dedicated to lease management, as Stephen mentioned, someone in the center of excellence who can catch these items prior to the effective date and ensure the lease management system or process is updated to reflect all applicable changes. At times, especially in the current economic environment, companies may be looking for ways to free up short-term cash, and they could do so through the renegotiation of their lease contracts. It is a decision that is likely to be made at the executive management level, but will have trickle-down effects for operating groups throughout the company. If a company-wide decision is made that impacts the lease portfolio, it is important to ensure key personnel from the accounting team are involved in the decision-making process, as the accounting team can articulate the impact of that decision. Renegotiation of lease terms will require mass modification of a lease portfolio. In my experience, mass modifications can be time and labor intensive, even if a company has utilized lease accounting technology to manage their portfolio, as all new lease attributes will be required to be reviewed and updated. In a situation of mass modification, it is especially important to ensure all new lease data is available and correctly input into a system or whatever form of calculation template is being utilized. What I've seen companies successfully do is follow a uniform checklist as they review each modified lease prior to adjusting it in a system or offline calculation. This will ensure that they are not missing any steps in the abstraction process of new data and will avoid further modifications in the future. Mass modifications can also occur if the lease data was not abstracted completely or accurately. Errors like this have the potential to cause remeasurement and adjusting entries that could date back to the initial transition to the new standard. Therefore, it is extremely important to avoid mass modifications of this nature and instead ensure the abstracted lease data is accurate and includes all required leases. On a monthly basis, if a company is utilizing an incremental borrowing rate, or IBR, as the discount rate used to calculate the value of lease liabilities, it is important for the lease accounting team or process owner to work with the treasury group at their company to obtain up-to-date IBRs for all new leases the company enters into. Failure to update the IBRs timely will result in the leases being misstated on the balance sheet and would result in potential adjusting entries or misstatements identified by the auditors. All right, so we'll wrap up this section with another polling question.
Super. Thanks, Catherine. Thanks, Stephen. Polling question number 2. What do you see as the biggest challenge in managing the lease portfolio on day 2? A, lack of dedicated internal resources assigned. B, doubts on the integrity of lease data. C, transition plan from third-party providers to internal group has not been established. Or D, it's not applicable, no current challenge is anticipated post-adoption. So again, take just a minute here to go ahead and respond to the polling question. And Catherine, just looking back here on some of what you and Stephen discussed as we wait for the participants to respond here, maybe just touch on some of those discussion points and what you reviewed in that section. Where have you seen companies be most successful in working with the new standard on these different points that you talked about?
Yeah, so in my experience, companies are most successful when they set up the organizational structure to manage the ongoing lease process. As Stephen mentioned, I've specifically seen companies succeed that centralize this function to ensure there's someone with the internal and institutional knowledge required to update the lease portfolio as changes occur, and just someone whose job responsibilities are specifically tied to managing and maintaining that lease portfolio.
Got it. Very good.
And it looks like, that is something that the majority of the individuals on this webinar identified as a point of challenge. So, it's good that you guys are aware of that and something to definitely focus on as you continue with the adoption of the new standard.
Yeah, for sure. That and the integrity of the lease data is showing up with quite a few votes as well. So. Good, that's very helpful. Addie, let's bring you into the discussion and transition a bit to highlight some of the challenges that we're seeing with business combinations and then integrating the acquired lease portfolio.
Yeah, sure. So one of the other areas we've seen our clients struggle with is the accounting for acquired leases in a business combination. So in this next section, we'll discuss some key accounting issues and practical considerations around the accounting for acquired leases. I've divided key considerations into two broad areas, the applicable technical accounting guidance from the business combination and lease accounting standards, and then also some, certain practical challenges integrating large acquired lease portfolios. So let's dive into the technical accounting considerations first. Our focus for the purpose of this session is specific to situations where the acquiree is the lessee under the lease contract. Although there are a few accounting considerations for situations where the acquiree is a lessor under the lease contract, because the majority of our clients typically deal with lessee issues, we focused our discussion today primarily on lessee accounting considerations. So I'll kick this off by talking about lease classification. So ASC 805, or the business combination rules, requires an acquirer to not reconsider the acquiree's classification of its leases unless there's a lease modification and that modification is not accounted for as a separate contract. A lease modification is a change to the terms and conditions of a contract that basically results in a change in the scope of the lease or the consideration for the lease. So for example, a change to the terms and conditions of a contract that adds or terminates the right of use of one or more underlying assets, or extends or shortens the contractual lease term, or increases or decreases lease payments will be considered a lease modification. Sometimes as part of a business combination, a lease might also be changed in ways that may not qualify as a lease modification. So for example, if there's a change in name of one of the parties in the lease to reflect the new ownership in the acquiree, that wouldn't be considered a lease modification. Lastly, if the terms of a lease are modified such that there's a lease modification, then the acquirer would use the modification guidance in Topic 842 to determine whether to account for that modification as a separate contract. We'll now talk about reassessment of key lease accounting estimates. The business combination rules require that the acquired lease be measured as if it were a new lease at the date of acquisition. This will involve a reassessment of the lease term, any lessee options to purchase the underlying asset, lease payments, and also the discount rate for the lease. The lease term needs to be assessed from the acquirer's perspective, and the acquirer should take into account any renewal or purchase options it expects to exercise. And also the acquirer needs to use the discount rate that's implicit in the lease if that's readily available, or otherwise the acquirer should use its own incremental borrowing rate as the discount rate for the lease. One key thing to keep in mind is that the acquirer would not reassess the acquiree's lease classification solely because the acquirer's assessment of the lease term or the likelihood of a purchase option exercised by the lessee is different from the acquiree's. We'll now talk about assets and liabilities arising from the acquisition of the leased portfolio. Obviously, we're going to have right-of-use assets and lease liabilities that arise from an acquiree's operating and finance leases. However, such leases are exceptions to business combination recognition and fair value measurement principles. Right-of-use assets and lease liabilities are recognized and measured in accordance with Topic 842. As all of you know, the lease liability is measured at the present value of the remaining lease payments. As if the acquired lease was a new lease as of the acquirer at the acquisition date. The right-of-use asset is the same amount as the lease liability. It's adjusted to reflect any favorable or unfavorable terms of the lease when compared with market terms. So accordingly, an acquirer would not recognize a separate intangible asset or liability if an acquired lease has favorable or unfavorable terms relative to market as of the acquisition date. In addition, the acquirer will also recognize intangible assets for in-place lease value. Basically, this can be thought of best as measuring the cost avoidance of not having to secure a new lease. So consider an example where you've acquired an industrial building with a single tenant. The market standard term for similar leases is 5 years. And at the time of your acquisition, the lease has 3 years of term remaining. You basically benefit from the avoidance of typical downtime or upfront costs of signing up a new tenant. And because of that, the accounting rules require the recognition of an in-place lease intangible asset in such situations. This asset is recognized separately in the financial statements and is not combined with other lease-related assets or liabilities. We'll move on to short-term leases. So under the business combination rules, the acquirer may elect not to recognize assets or liabilities for acquired leases that at the acquisition date have a lease term of 12 months or less. Rather, the acquirer that makes this short-term lease accounting policy election will recognize fixed lease payments as an expense on a straight line basis over the lease term, or variable lease payments as an expense in the period to which they relate. This is consistent with the guidance for short-term lease accounting under Topic 842.
So Addy, just a quick pause there, thinking about a couple of those concepts that you just went through. What about off-market terms on short-term leases and the related assets and liabilities? Would a company need to recognize those assets and liabilities if the underlying leases themselves aren't being recognized?
Yeah, great question, Bill. So the business combination guidance clarifies that the acquired short-term lease recognition exemption, when elected, also applies to intangible assets or liabilities for favorable or unfavorable terms of such acquired short-term leases. It's also a widely accepted practice to apply this exception to in-place lease intangible assets associated with short-term leases. So in substance, you wouldn't recognize any assets or liabilities associated with short-term leases on your balance sheet. Moving on to accounting policy elections, there are certain policy elections that need special considerations since these could impact the recognition and measurement of lease-related assets and liabilities. The two specific ones that come to mind, one is the election to separate lease and non-lease component by asset class. And then the other is the utilization of a portfolio approach for certain classes of leases. So the acquirer will need to determine the acquiree's policy elections and make adjustments to cash flows that will need consideration to conform lease accounting policies of acquired leases with its existing lease accounting policies. Finally, we'll talk about favorable and unfavorable leases with favorable and unfavorable terms. I already alluded to this previously, but from the perspective of the acquirer, a favorable lease represents an asset, while an unfavorable lease represents a liability. The acquirer accounts for each favorable or unfavorable lease at the acquisition date as an adjustment to the ROU assets. So you're not going to have separate assets and liabilities in your balance sheet associated with favorable or unfavorable terms. I've also noted some additional accounting considerations that one will need to pay attention to in this next slide. The accounting treatment for leases with these type of features are fairly nuanced, and accordingly special attention will be needed on these type of leases. In the interest of time, I don't intend to go through these specific areas, and I've noted them on the slide to serve as a reminder for those that have acquired leases with such features. Typical leases that require additional consideration are leases, your sale and lease backs, leveraged leases, acquisition of leases where the acquirer is a lessor. So, if you got lessor accounting issues, you've got customer relationship, intangible assets where the acquiree is a lessor, and also lease contracts between the acquirer and the acquiree for pre-existing leases. Now let's talk about certain practical challenges specific to integrating an acquired lease portfolio. The first point I want to make here is identifying previously unidentified embedded leases in acquired lease service contracts. Embedded leases are leases contained within larger service agreements. So for example, a company enters into contract to advertise on a billboard. Although this contract could be written as an advertising services contract, the right to use the billboard might meet the definition of lease, and you might have to bring on right of use assets and lease liabilities associated with that contract onto your balance sheet. So similar to the exercise performed by the acquirer in identifying contracts with embedded leases as part of their 842 adoption process, a diligent approach will need to be undertaken with acquired lease portfolios. Some leading practices to identify embedded leases include inquiries with operations, basically meeting with relevant departments to understand the type of service contracts that exist and discuss the specific concepts of ASC 842, definition of lease and name and terms so that the contracts with embedded leases may be identified. Assessing areas of risk and performing a risk assessment to identify areas where embedded leases are more likely to exist. Reviewing the expense activity in the GL to identify payments that occur on a monthly or quarterly basis. That might signal a need to review the underlying contracts. Performing physical inspection, walking through manufacturing facilities and office buildings to identify leased assets that might not appear on fixed asset listings or lease listings. And then finally, getting the help of the legal department or of the company to actually help review and identify contracts that might have embedded leases. So basically look at all contracts and educate them on embedded leases and have them identified for the accounting team. Next, we'll talk about getting a detailed understanding of the acquired lease portfolio. This activity we found is often overlooked and ignored by management. In our experience, companies that did not take the time to fully understand the nuances and complexities within the acquired lease portfolio are often surprised at the complexity of some of the contracts and the amount of work that they have to perform to actually integrate those leases with their to appropriately integrate their leases with their existing lease portfolio. So ensuring a detailed understanding of the portfolio would resolve a lot of issues down the road, especially during the integration process. And we therefore recommend that this is done during the due diligence stage or quickly thereafter, as soon as the purchase transaction is consummated. A recent example that I can think of at an existing client where the lease portfolio included a number of leases that had prepayment features. And as such, these were not accounted for appropriately, primarily because previous management had not taken the time to understand or identify such leases within their lease accounting system. Additionally, we found a fair amount of inconsistency in how lease terms and end of term options on those leases were entered within their lease accounting system, resulting in inconsistent application of the acquiree's accounting policies around these areas. So we spent a fair amount of time and effort to adjust these issues and correct these issues while integrating those leases in. We'll now talk about differences in lease accounting systems. Management must first decide which lease accounting software solution they're going to use on a go-forward basis. And in most instances, we see the acquiring entity, the acquirer, retain its current accounting solution. But in some situations, we've seen management take advantage of the business combination to reassess the capabilities of each of the lease accounting software solutions and select the one that's best suited for their ongoing operations. We'll now talk about lease data normalization. Lease systems they've been built by non-accountants and have a lot of non-accounting jargon and nomenclature that is often confusing. Additionally, different systems have different requirements to calculate the classification of a lease, and accordingly, the underlying lease data will of the acquired leases needs to be normalized based on system-specific specifications and coding conventions. On a recent integration project, we spent a considerable amount of time and effort around normalizing the data in order to move the purchase lease portfolio between two leading lease accounting software solutions. In particular, the purchase lease portfolio had a large number of leases with uneven periods, basically partial months. And a difference between the two systems in the method of input of lease data for leases with uneven periods resulted in additional complexity and effort on our part to get the acquirer system to appropriately account for these leases. We've also found that entities do not fully utilize the non-required organizational functionality within lease accounting tools. So things like project codes, location information, cost centers, etc. And this could require effort to ensure that purchase leases have data consistent with the acquirer's existing lease data when integrating such leases with the acquirer's leases. Management may also want to take advantage of these kind of remapping efforts to review and modify the coding convention. So things like adding asset groups, segment information, and things like that. It's also important to identify leases with unique terms and complexities. We have found that often the accounting for such transactions are not appropriate and need to be revisited as part of the integration. Common examples, sale leasebacks, built-to-suit arrangements, embedded leases within complex service contracts are typically the contracts that we would recommend you look at. Moving on to completeness and accuracy of data. This is obviously a hot topic with the auditors and an area that the auditor will zone in on. Management will need to ensure that all data is complete and accurate. We found that many lease portfolios wrongly contain leases that have been terminated or have expired, where the lease assets have been returned, leases with negative base rent amounts, things like that. And this type of incorrect lease data will need to be reconciled and corrected in order to ensure all acquired leases are integrated, complete, and accurate underlying lease data. A question I always get is if the assessment of the accuracy of lease data requires the acquirer to go back to the source document. Another question that comes back quite often to us is how should an acquiring company assess the pros and cons of relying on the acquirer's 842 accounting? We recommend certain activities to quickly assess the amount of work that needs to be done and quickly assess how much work the acquirer has already done. One is review the adoption memo of the acquiry. If there isn't one, that's an indication that the standard wasn't appropriately adopted. The other is scrutinize certain critical reports of the adoptee to identify any anomalies that might suggest inappropriate data entry. The next topic is around processes and controls, obviously a pretty hot topic as well. Again, you want to make sure that you update your processes and controls to accommodate for any new leases and leases that are signed between the closing date and the acquisition and the date of the signing of the acquisition and the closing date of the acquisition, and shortly thereafter. Developing a process is of paramount importance. With that, I think we can move to our third polling question.
Yeah, super. Thanks very much for those insights, Addy. Appreciate it. Polling question number 3. Within the context of a merger or acquisition, which areas of an integration of a lease portfolio has been or do you expect will be most challenging? A, normalization of acquired lease data. B, ensuring completeness and accuracy of the lease population. C, identifying embedded leases in acquired service contracts. Or D, updating business processes and controls to support the newly acquired leases. Addy, while we're waiting for some responses there, you're looking at C there, embedded leases, maybe just provide, I know you touched on it, but provide some additional examples of embedded leases to help our participants in identifying those types of leases.
Sure. So things that come to mind are things like contract manufacturing. So for example, let's think about a retail apparel company that contracts with a manufacturer to produce shoes, and the manufacturer dedicates a specific facility to manufacture the shoes for the retailer. And substantially all of the capacity of that facility is being used by the retailer. So that would be a good example. Rail cars or any transportation type agreement where you're using specific rail cars or specific vehicles to transport your product. I work in the E&P space quite a lot, and we see rigs and frac fleets So you have a drilling, drilling services agreement, and they're using specific equipment to drill a well for the E&P company, and that might qualify as a lease. Other examples are, data service centers. That's, you find that a lot. Warehousing, transportation, logistics contracts. I mean, there are quite a lot of areas that you find embedded leases, and that's why it's a pretty hot topic at this point. So it seems like, in looking at the results from the poll, the completeness and accuracy has, is 36%. It's obviously, like I mentioned, is a very, it's a key point that the auditors are concerned about, and obviously, the data that goes into the system, your reports, and the information that comes out is only going to be as good as what it is. So. But across the board, I mean, obviously there's no right answer, and each situation is going to be different. But it's definitely interesting that all four criteria are things that people expect to be challenging. Yeah.
All right. Very good. Thank you, Eddie. Let's shift over to David and bring you in and talk with our audience some of what we're seeing on the governance side with internal controls and how to mitigate audit risk.
Thanks, Bill. As we discuss ways to minimize audit risk, you'll likely hear common themes discussed by Stephen and Catherine as the challenges faced during implementation in day 2 will present itself during the audit. To help understand how we can reduce audit risk, I first want to take some time understanding the audit assertions and where auditors are likely to extend their focus. In our experience, the focus will be on completeness, valuation accuracy, and presentation and disclosure. When testing completeness, the auditors want to ensure that you've captured all lease arrangements, any arrangements that contain a lease, and you've processed your modifications correctly. As Addie mentioned, the new challenge for 842 is identifying embedded leases. Additionally, if a system was implemented, there are likely additional audit steps to ensure that that system was configured appropriately, it is able to generate the required journal entries under the new standard, that the journal entries generated can be posted to your existing ERP, and that all lease data was appropriately captured from previous sources. We haven't seen auditors spend too much time testing the physical existence of lease assets. However, they will confirm that the lease data agrees to lease agreements. Testing the valuation accuracy is clearly going to be one of the most scrutinized aspects of the audit. We've seen auditors take a fairly substantive approach here, given the challenges Stephen and Catherine mentioned, given the rush to adopt 842. As a result, it was common to see the control environment lag the accounting compliance. When testing valuation and accuracy, auditors will focus on areas that impact the calculation of the right of use asset and lease liability, such as the initial payment schedule, how you are treating reasonably certain renewal periods, how the IBR was selected and if it's consistent with your policy, if the asset is going through transition, how consistently it was applied to your practical expedience, and they will test if the right of use asset and lease liability is calculated in a manner consistent with your new policies. And the reason why I emphasize that is we have seen some clients where they calculated the right of use asset that differed from their policy. They intended to account for or track lease incentives outside the system, but when they input that data into the system, they were netting payments for that lease incentive, in effect, accounting for it in 2 different places. All the testing will focus both on transition and for day 2 activities. One thing to keep in mind is material leases will be recalculated by the auditors. For companies that took the package of practical expedience, the cutoff procedures will focus on leases at period end, since the determination of the lease term and classification will not change in transition. While it has been rare in our experience, if you elect the hindsight practical expedient, you would be subject to cutoff testing at transition, since the lease terms can be reassessed. We've had some clients faced with processing activity in a given period, and in some cases, clients recording lease activity in a month in arrears. They discussed this with their auditors, and any activity was determined to be immaterial. And so, it was an important thing that they discussed with their auditors up front, but the volume was just too significant to ensure capturing all activity in the proper period. When assessing rights and obligations, it will be determined whether or not you have the right to use the asset. Similar to existence, this will be tested when the auditors review lease agreements. Regarding presentation and disclosure, the focus here will be around how you are treating items in addition to base rent, with a focus on lease classification, how you are capturing short-term leases, variable rent changes, and sublease activity. The auditors will want to understand the process you're using to aggregate all that data. If you're leveraging a system, does the system have the full capability to provide all the inputs for footnote disclosures? If not, what additional manual processes do you have in place to ensure that all the appropriate data is being captured? If you are using a system, the auditors will want to understand how the system is calculating the inputs for the disclosure. And then lastly, they'll want to ensure that you are properly tracking and presenting all the relevant information. Now that we've discussed what the auditors are likely to look and test, let's discuss some effective steps and internal controls we've seen facilitate compliance through pre and post adoption. The goal over the next 2 slides is to discuss measures to help build an internal control foundation with the goal to be able to optimize the process for subsequent audits. Again, in our experience, most first-year audits will be substantive in nature given the challenges discussed. Quite honestly, the adoption was more challenging than clients expected, and most systems were close but not 100% ready. One of the items we found effective during the pre-adoption phase is ensuring executive-level oversight. Auditors will want to understand the overall 842 approach, and one of the key elements that we've seen greatly improve the chances for a successful adoption is executive-level oversight. Having that presence sets the tone for the project and instills accountability amongst all team members. Auditors will pay keen focus on how you've addressed certain key risk areas. They are likely to focus on how you've developed new processes, identified appropriate controls, with an emphasis around completeness, data integrity, adherence to Day 2 policy, and IT risk. In terms of completeness, auditors will focus on the processes identified to ensure all relevant lease data is captured, that new processes are typically required as historical practices are not adequate given the lesser focuses on leases historically. In terms of data, auditors will want to see how you're ensuring the correct data is being abstracted from the leases. As Catherine mentioned, there will likely be a cleanup effort given the rush to implement and lack of knowledge around the new standard. The goal here is to continually train team members as much as possible to mitigate these issues going forward. Another consideration is whether or not the data abstracted is consistent with your policies. When looking at IT risk and implementing a new system, the auditor will want to ensure that you've thought through all the appropriate system controls and that you've tested that they are functioning as intended. From an accuracy standpoint, the auditors will want to understand the use cases that you have in your portfolio and how you tested the calculations from the system. Obviously, during the pre-adoption phase, developing accounting policies is critical. We won't go into any detail about any of the policies specifically, but just one thing I want to point out is that we have seen clients adopt a materiality threshold. While not specifically identified in the standard, several clients have worked with their auditors and often have aligned that materiality threshold with the capitalization policy. The key here is to stay in constant communication with your auditor during this phase of the project. Given the complexity around the standard and as discussed previously, adequate training for key stakeholders should not be overlooked. Often we see clients that are, after adoption, still lack the internal subject matter experts to help navigate post-adoption issues. As Stephen mentioned often, times the adoption levers external resources and the institutional knowledge needs to be transferred or augmented. Regarding post-adoption, the focus here is around the future state process. How have you decided new leases and changes to existing leases are going to be communicated to the respective stakeholders to ensure proper classification, measurement, remeasurement, and appropriate disclosure? Systems will likely be used, so the key question here is, how is the correct data inputs getting into the system? From a workflow perspective, how are necessary approvals being tracked and documented? For example, is it going to be controlled through the lease accounting system, or will it be done outside of the system? Given the rush to adopt, workflow and process optimization is often a phase 2 consideration in an area we find our clients spending time today. We've seen the adoption take a couple different shapes depending on whether or not the adoption was considered an accounting compliance exercise or a business process transformation, with the key differentiator being who transacts the day 2 activity. While either approach has seen success, we find that those that view this more as a business process transformation have had an easier time with the transition. It's really imperative that you leverage the institutional knowledge of these teams to understand whether or not activity should be treated as a renewal, a modification, or a correction to original lease data. Regression testing is going to be a critical control post-adoption, as systems are often updating and require regression testing to ensure that the accounting calculations are being done so appropriately. Lastly, if you implemented a system, you want to make sure that if you can rely on IT controls when available. And some things to consider are there role-based controls? So can you restrict access based on business unit or company? Does it support workflow? And if it can, does it also act as a document repository? And then lastly, can you close accounting periods to ensure that your lease accounting, subledger, and ERP will reconcile?
So David, just a quick question to jump in here on. We've discussed both the pre-adoption, post-adoption side of internal controls. What are we seeing with with clients, folks you're working with? What are they doing well, and where there's some room for improvement?
Yeah, thanks, Bill. So I would say in general, the pre-adoption phase is where we're seeing most clients perform well. Getting out in front of new accounting policies, keeping that line of communication with their auditors. I think where we're seeing room for improvement is kind of what Catherine and Stephen referenced around optimizing the day 2 processes, really ensuring that you have a process in place to help interpret your day 2 transactions. Where we've seen clients perform well in terms of the audit is when they focus on areas that impact completeness, valuation, accuracy, and presentation and disclosure. Throughout the adoption, you want to ensure constant communication with your auditor or subject matter experts to ensure that you feel comfortable with your policy elections and any complicated day 2 activity. You want to take all the necessary steps to ensure you're comfortable with your existing lease portfolio and look to identify any new leases or embedded leases in order to ensure that you have a good starting point. As Stephen mentioned, to help facilitate day 2 compliance, we've seen success with clients developing decision trees or other guides to help interpret complicated accounting use cases. Additionally, you'll want to ensure continually training the staff. As it's imperative that, and we've seen success with our clients, if they have a subject matter expert that is able to identify and triage issues real time, as opposed, during the audit period, will certainly facilitate your year-end audit. As Catherine mentioned, having a robust contract management process will help with the timely reporting of data. I think the last thing I just want to talk about is, while it's minor, if you're using a system and you can grant them access, that should alleviate some of the administrative burden as you work through the audit. I appreciate your time talking through ways to identify and minimize audit risk. With that, it's time for polling question number 4.
Excellent. Thanks very much, David. Polling question number 4. In preparing for the audit, what concerns you the most? Completeness of your lease portfolio. B, identification of embedded leases. C, accuracy of the right of use asset, lease liability accounts. Or D, strength and consistency of internal controls and system controls. So go ahead and take just a minute there. And David, maybe just briefly touch on just some additional methods that you're seeing clients use to ensure completeness of the lease portfolio.
Yeah, so I would say, starting with your prior year disclosure is a great starting point, but keep in mind the definition of a lease has changed under 842. So again, it's just a starting point. We've had clients have success identifying new leases or lease payments by reviewing their recurring AP schedule. Again, Regarding embedded leases, like Addie suggested, bringing in a legal team to review or have, team members appropriately trained, and then make sure that you are involving the operations team because they are the key to a lot of the documents and transactions related to leasing.
Yeah. No, very good. Thanks very much, David. Looks like completeness of lease portfolio won out there in terms of where most of the responses, or at least a plurality, came in. So thank you for that. We did receive some questions from participants. Appreciate that. Well, let's see if we can try to get to one of them here briefly. Addie, this one's probably good for you, around SEC comment letters and what the SEC has been saying and what are the trends there around lease adoption, where companies should be focused based on what we're seeing from the SEC.
Yeah, for sure. So as expected, the SEC comments specific to topic 842 have been focused on highly complex and judgmental technical accounting areas and disclosures. So they're really two buckets. A number of comments were requested directly in providing additional information to support the judgments and assumptions made by management on specific transactions. So if it's a material transaction like a sale leaseback or impairments or intercompany leases, things like that. There were also some comments requesting more information on the determination of some key accounting estimates like the weighted average discount rate, the rate implicit in the lease, accounting for lease incentives, things like that. In the second bucket, we had the SEC request enhanced disclosures related to the nature of leases, including key terms and conditions, information supporting why certain assets or leases or contracts are not within the scope of 842 or are within the scope of 842. And then one of the recurring comments was around the 840 disclosures for all periods that were reported in accordance with 840. So when a company adopts the standard using the modified retrospective approach, they're required to disclose for all previous periods the 840 disclosures, which some companies have not done. So that was another area that was specifically highlighted by the SEC.
Very good. Okay. Thanks for that. And thank you everyone for joining. It was great to be able to spend the last hour with you. In closing, let me just highlight here on the screen, you'll see some of our recent thought leadership that, again, you'll have this deck. You'll be able to click through to it and access some of that, as well as being able to reach out to our experts as well. So we look forward to meeting with you again on August 13th. We'll engage in a discussion then on M&A and specifically post-merger integration, how to successfully navigate that landscape. So keep an eye out for that invitation. But thank you again for being with us today. Enjoy the rest of your day.